started so we have a full amount of time for a really interesting discussion. It's wonderful that so many of you can join us here at the Australian Pavilion. My name is Sasha Corville. I am the CEO of the Carbon Market Institute. It's my pleasure to be moderating this session on one of the most defining challenges of our decade, which is really how to accelerate climate and nature solutions through finance. I would love to acknowledge the traditional owners of the lands on which we're meeting from the Amazonas area, and just kind of, I guess, one of the things that has struck me walking through COP is just the sheer leadership and vibrance and discussions from Indigenous communities all over the world. It's been a really fantastic experience to be able to hear and listen, and I'd love to acknowledge any traditional owners, First Nations community representatives here today. We're meeting here at a pivotal moment in time. We need COP30 to be the implementation COP. But what we need most, well, one of the things that we need most is, and we're not really seeing it, is we need a lot more finance flowing to address climate and nature challenges. We're not mobilizing finance at the speed at which we need to. Global climate and nature investments need to triple by 2030. Developing countries are calling for clearer commitments on the new collective quantified goal on climate finance, while private investors are calling for clear policy certainty, project pipelines, and risk-sharing mechanisms. And this is all at a time when public budgets are under pressure. So this panel is going to explore how do we bridge ambition with action? How do policy, capital, real projects come together to unlock investment for clean energy, but not only clean energy, for nature repair, resilience, and a just transition in Australia, in the region, and around the world? So we're fortunate to have three amazing speakers who will have lots of insights to share. We have Heech Sung from the Clean Energy Finance Corporation, who has a very unique role in the Australian ecosystem of providing much critical finance that creates blended finance opportunities to bring in the private sector. And we have Fred Teo, who's the CEO of Gen Zero, a global investment platform backed by Temasek, investing in nature-based solutions, decarbonization technology, and carbon markets across Asia. And finally, Peter Castells, CEO at Climate Zeitgeist and convener of the Climate Investor Forum, working to connect global capital with high-integrity climate and nature solutions. So welcome, everyone. So the session is going to be run. We're going to open it up for everybody to give a few initial reflections and comments. Then we'll have a moderated discussion. I have some good questions, I think. And then we'll have an open Q&A discussion for anybody to throw anything out that you want. And then we'll finish it up with a few final remarks from our panelists. So everybody ready? All right. So the first question that we really want to dive into is, how do we scale finance? So I might initially ask Heech this. Just a bit of context, the CFC has helped crowd in $12 billion in private capital in 2024 for the energy transition, and substantial natural capital investments as well. So from where you sit, what policy or market conditions in Australia are making climate and nature investments easier, and where are the gaps?
Thank you, Sasha, and thank you for staying behind after that electrifying Australian bid for COP31. So thank you so much for that. So for those who don't know, the Clean Energy Finance Corporation was established over a decade ago by Julia Gillard's government to deploy capital into renewable energy and low emissions technology. That is our mandate. It's very clear in our Act. So what does that mean in a real lived investment environment? We heard Paul just now talk about we're going to invest our way through climate. You have, big economists like Nick Stern saying climate action is the growth story of the 21st century. And, he's a pretty heavy hitter, and he is backing climate action as an investable opportunity, not a plus to have. So we need to bring back climate investing as a core function of the investment platform rather than a side-on or an additive to the investment platform. So I think that's important. And the CEFC's mission to help Australia transition to a net zero economy is not only through investing in renewable energy projects, but actually the hard to abate sectors that won't transition with energy transition alone. So they are sectors like transportation, agriculture, and broader natural capital landscape investments. So I would, just some high level stats, you talked about 2 billion of private capital. We have committed about just shy of $19 billion worth of capital to date, with a transaction value of $85 billion. Now, they're big numbers, maybe not big in the global climate context, but the reason why that's important is that value is what goes back to the Australian taxpayer for not only reinvesting in other public goods and services, but also more clean energy investment. So we have to make these investments commercial, and so we are doing this one investment at a time. And the way we do it is we structure transactions that, you know, my colleague to the right can invest in and to deliver shareholder returns. So it is finding the market where capital can be deployed efficiently, but also where you see value. And that growth story of the 21st century is a really good thing to have in the back of your mind, because it is not a small asset class evolving. This is fundamental to our investment opportunity in the 21st century. And so some of the strategies we're deploying is to come up with investment strategies that resonate with big institutional capital. So pension funds, like the Canadian pension funds LACASSE, who we've recently launched a agriculture carbon farming platform with. Now that's $450 million worth of equity into a strategy of sustainable farming and carbon projects in Australia. They are a new entrant to the market, and their pension fund is bigger than Australia's largest pension fund, which is Australian Super. So Australian Super, our largest pension fund of $380 billion worth of assets under management. They and other pension funds, it's their investment capital that will drive that sustainable change. And if you look at Australia, I know it's a bit long-winded, but some of the interesting things that they've discovered is that circa 90% of their investee companies in the Australian share market, which makes almost all of their Australian share portfolio, have committed to a net zero outcome. So that's enormous for, you know, what they're doing is saying corporate and private companies will spearhead the transition, right? Government policy will need to be there to support it, but as we all know, policy is subject to political change, and therefore private markets have to step in on the fundamentals. And so the fundamentals of the energy transition is what is going to spearhead more investment into this sector.
Thank you very much. Maybe, Fred, would you like to just talk a little bit about Gen Zero and
Sure.
maybe some initial reflections?
Well, happy to do that. Right, so Gen Zero was established about 3.5 years ago by Temasek. They are our only shareholder. We were given an initial capital commitment of 5 billion Singapore dollars to begin our work to accelerate decarbonization solutions globally. So there are 3 investment focus areas that we have. The first one is into nature investments with the aim of trying to restore or protect natural ecosystems. We cover the gamut of activities from conservation to reforestation, sustainable forestry to sustainable agriculture. And in fact, quite a lot of our money or capital has actually been deployed into North and South America, even outside Asia. The second area that we focus on are actually technology-based solutions. So they focus on hard to abate sectors, like what Yi Chung was saying, into things like sustainable aviation fuel, low carbon materials like bioplastics, low carbon cement, and also into certain types of carbon capture capabilities that are perhaps a bit more cost effective in the nearer term. And finally, we invest also into a third focus area, which is carbon ecosystem enablers. Sounds like a mouthful. It essentially is about carbon market solutions. And in that, we have, within our portfolio, we are the largest institutional investor into a global advisory company called South Pole, which some of you might know. We are the largest institutional investor into the carbon exchange in Singapore. We have got a carbon rating company called B0 as part of the portfolio, and things like that, right? Now, maybe I should spend a few moments explaining why we have these three focus areas and what is the thinking behind that. Now, we are a commercial investor. So that means that while we are a climate impact investor, we are expected to deliver commercial returns to our shareholder. But because we are a double bottom line investor, we are also expected to deliver climate impact measured in terms of carbon tons removed or reduced from our investments, okay? So if we take our three focus areas, I see nature and technology as a little bit like a natural hedge for each other. And why do I say that? We all know that if we want to achieve net zero, we will need to be able to have fundamental industrial decarbonization of our economies, right? We are not going to be able to offset our way to net zero. Now, that will require us to adopt many technology solutions that today are relatively expensive, okay? So we don't know exactly when some of these solutions are going to be cost effective and available at scale for us to adopt. Now, because if we have the luxury of time, we can wait. But because we don't have the luxury of time and we have a 2050 target, then it's important for us to think about what if this doesn't really work or doesn't pan out in time. Nature for us is also a very important strategy then, because in and of itself, it is valuable. It is important for us to protect natural ecosystems, rainforests like what we find here in the Amazon. It is important for us to go for reforestation, but more importantly, these measures in nature can help us to address the important net zero targets should technology solutions not come online fast enough, cheap enough, right? More importantly, we ask ourselves a question. If you want to achieve financial returns, you want to have solutions that are today at scale, right, and can actually deliver impact. Nature makes a lot of sense, right? However, nature investments are extremely hard, right? The returns are oftentimes quite poor. And therefore, with the technology investments, while the impact might not be as near term, the longer term returns profile for technology investments generally would be better. And so these two things kind of like complement each other. Now, that said, then how do we understand the third pillar of our work, which is around carbon markets? The way that we see carbon markets is not really about carbon credits and offsets. The way that we look at carbon markets is about having efficient platforms for us to channel financing into the underlying solutions that today are not commercially viable. Think about it. Why would anybody deploy capital at scale to protect a forest halfway across the world? Why would you now be able to put money into direct air capture solutions or many other things or sustainable aviation fuel that today you cannot really see clearly the line of sight to rapid adoption? Now, the only reason why you would do that is if there is a logic around carbon credits, right? That you are able to claim some of the environmental attributes either for compliance or voluntary reasons, and you pay over the top for it. So we see carbon markets efforts as ability to be able to channel financing much more effectively into the underlying tech or nature solutions, and that's the reason why we support an effective, deep, liquid carbon market. So that's roughly how we organize our work.
Brilliant, thank you. And Peter, would you like to give us a few opening remarks?
Yeah, thanks very much, Sasha. And thanks to the Australian government for putting together this pavilion and for putting the panel together. For many years attending COPs, there wasn't an Australian pavilion. And so the only time you got to meet with Australians was when someone else had beers at 6 o'clock and all the Australians would gather over there. So I'm not saying that we haven't got the beers, because that would actually also help bring people here to this fascinating discussion. Thanks, Sasha, too, and congratulations on your appointment to the CEO of the Carbon Market Institute. It's at a really critical time. It's a great organisation. but in the sort of words taken from Flying High, good luck, and we're all counting on you because it's a really important time. It's great to hear both Heech and Fred's perspective from where they sit with both two very innovative vehicles that have been established, and the governments both of Australia and of Singapore that had the foresight to set up the CFC and to set up from Temasek's investment in Gen Zero has allowed the kind of innovation that both of some of those examples that you've given. Because if we go back 10 years to the Paris Agreement, at that time, it was really governments that were leading the definition of what we need to do about climate change and climate ambition. And in the diplomatic triumph that was Paris, we saw for the first time business and government were engaged in that process and then took the lead in many of the things led by people like Mark Carney, who defined what we need to do in terms of climate risk. It brought corporates in, and since then we've had a really significant progression of engagement of different components of the finance and investment sector in this space. That didn't happen before. We weren't, the capital markets weren't engaged in the way they are. We just had in the last panel, we had Paul from Woolamai, and we've had examples of other companies and investment funds that are here demonstrating that their investment in the climate action is part of this transition that's going to take place over the next decade, 2 decades, the rest of this century. And so we should really acknowledge that we've come a long way. So we've got a great platform. There's a lot of negativity and a lot of fear around ESG retreat and around changing global policy commitments to climate change. But the energy you get from walking around this place and the experience by sitting in the Chinese pavilion or going to some of the Pacific Island sessions, you know that there's a forward momentum here, and the direction of travel is driven by that mother of all market signals that came from Paris. So my sort of opening comments, I suppose, taken from an opportunity that I get in running the Climate Investor Forum in Australia, which is really bringing investors, climate solutions, buyers and government agencies together to actually facilitate the connection of capital to climate solutions. One of the things that I know is fundamental in any transactions happening is that people need to get together and know each other and interact with each other. Business doesn't happen unless you actually can have trust in the organisation. There wouldn't be one investment either of you have made where you don't get to know the CEO of that company or the culture of the organisation. And so these kind of gatherings at a global level are amazing, but when we bring it down to, well, how do we actually move the dial, more of that facilitation and interconnection and getting alignment is really important. And when we pick up some of the bigger market signals that we get from here, we only have to look at the NDCs to see these are country management plans and business cases for investment. If you take something like carbon markets, over 100 country plans have use of markets as part of delivering on their Article 6. So what's the demand that comes from when you read that? Get some AI to go through all of the NDCs and you'll come up with a figure. I got my nephew to do that because he's really good. And it's astounding. You can quantify how much emissions reduction are actually written in these plans. So where's the supply coming from? And where's the supply coming from that's going to have the levels of integrity, that's going to meet the levels of the standards that we're going to require? And this is why this conversation around looking at nature-based solutions, looking at leveraging carbon markets are relevant to what countries need to do and what companies need to do to actually meet their commitments.
Thank you. In the interest of time and making sure that we're getting through, I'm going to ask the same question for all of you, but it's kind of, I'm sure it'll be broad enough, which is, what are you seeing in the market that gives you confidence, in either market or policy frameworks, that gives you confidence to be able to invest in climate and nature? And what would you like to see? Where are the challenges? What's missing?
Maybe I can start off with sort of the big sort of number around capital that's available. There's about $2.5 trillion worth of private capital, dry powder, globally available for deployment. And that dry powder, what does it mean? It means that they're looking for homes to invest in. And there is a little bit of concern because some of that dry powder is aging. So, it's finding it hard to deploy. It's finding maybe investments aren't returning fast enough. So if there are investors in this room, I would encourage you to think holistically about your investment strategies in climate solutions. It's not just a one-off set and forget investment. You have to think of the life cycle of that investment and think about the liquidity profile of that investment. So that's one of the things I hear a lot from private investors is, you know, how do we get liquidity in some of these investments? So that's what we're, you know, that's one of the constraints in an investment, you know, with an investment lens, why some of these investments are difficult. But where policy can really step in is particularly with a focus on carbon markets and now the evolving biodiversity and nature repair markets, is that it underwrites some of the cash flow that's needed to support these investments. And I'm not just saying that because it's academic. We have recently deployed significant amounts of money into land-based solutions where a significant portion of the revenues come from carbon credits. And the Australian carbon market is unlike any other market in the world. It fundamentally a compliance market that is underpinned by nature-based investment solutions. So when I hear people say it slows down decarbonisation, it's a bit of greenwashing, doesn't really help, well, I think you have to look at the underlying premise in the projects. The carbon markets really speaks to the carbon budget of big corporations and their emissions and how they are going to address this problem. So rather than trading emission certificates, perhaps like the European Union market, in Australia we have an opportunity to redirect that carbon price into real life projects. So what does that mean? It means investments in soil health, trees, waterways, and that's what we're doing. And big facilities are paying for it. They are paying for it. And it's also funding First Nations groups to bring, to kickstart new economies for their people. And so it's paying for jobs and employment. That's where the carbon credit funds are going to in many of the carbon projects that we're supporting. And so those policy initiatives are incredibly fundamental to decarbonising not just Australia's economy, but globally. But to get there, we need stability. We need policy stability. Investors hate instability. So, and if you lose an investor's trust, it's very hard to regain. So I would urge all policymakers, whichever side of the aisle you sit, you have to have a stable policy framework in order to bring in flows, in order to have some of that $2 trillion dry capital investing into this asset class.
Actually, Hitch, could I ask you a question? So I'm a newbie at the ACCU markets in Australia, right? So there are different project types that are eligible within the ACCU market. Are all project types equal?
No, well, as a carbon tradable unit, they're equal, but the underlying projects are not equal because the capex cost for those projects are not equal.
So in a compliance market, as I would know it, right, in many other settings, compliance markets will tend towards commoditized outcomes. And it will drive the cost down to as low as possible because it's, after all, compliance. You're not going to get a leg up or anything from paying extra for something that might be somewhat better because good enough must be good enough, right? Otherwise, there is no basis for a minimum compliance regulatory standard per se. So what incentive would there be for corporates in Australia to buy ACCUs that are perhaps of a much better quality potentially, right, at a higher price if it is going to be treated the same as a potentially lower quality ACCU that is cheaper?
Yeah,
Why would they not go for the cheapest possible
That's
ACCU?
a really good question, and they have been. And so the thing I would say, and I'm speaking to the purchase of ACCUs, is of course they want the cheapest cost of an ACCU, but you've got to think of what is that baseline, right? What is that cheap cost of an ACCU, right? Our current ACCUs probably about $35 an ACCU. What does that actually pay? It pays for a lot. So, but if you pay an extra $10, $15, what you get is a lot more natural capital outcomes on some of these projects. And what I'm hearing from safeguard facilities and purchasers of these credits is it's reputation risk they are managing, right? They are willing to pay a little bit more to not only manage their corporate reputation, but also to be able to invest back into nature in a way that makes sense for them. Because they've obviously got a carbon price that's greater than what we're selling our carbon credits for at the moment. So what the incremental cost is actually for them, it gives them a lot of leverage to say that they've been investing in landscapes.
Okay, in a voluntary market situation, I understand the risk of reputational issues, right? Because it is the corporate that is making a choice. In a compliance market situation, I mean, is every single ACCU good enough?
Well, I would say, I'd make the policy statement and say an ACCU is an ACCU, but
Okay.
what we are seeing is that purchasers of ACCUs are now diligencing the underlying projects.
Of course you
They
should.
are not, and because they're nature-based. And so what I would say is, an ACCU is an ACCU, but the underlying projects are not the same. And so people are pricing, different projects, accordingly.
Well, I
and
can-
what they're doing is they're taking a portfolio approach to purchasing ACCUs rather than chasing the cheapest ACCU. And maybe I would also say one more thing. I don't think the distinction between voluntary carbon purchases and compliance purchases in the Australian market are that different because they are nature-based outcomes. And so I would say that in the same way a voluntary corporate buyer is looking at the integrity of those credits, the cost of those credits and what they're paying for, compliance buyers are doing that for a big portion of their ACCU book. I mean, Peter's got probably some insights there too.
Yeah, I think it's a great question, Fred. There's a difference between, say, landfill gas generated credits, and the predisposition of someone in Treasury is always to go with the lowest cost of compliance. And so when we look historically at the safeguard mechanism and we've seen what units have actually been acquitted against the liability, they've typically been credits that have been held that are tradable at a low cost and from methodologies like waste management. I think it's where Heach is sort of touching on is this convergence between voluntary and compliance in terms of the one purchase that meets multiple objectives is where the buyers are heading towards. We'll start to use up that low-hanging fruit of cheaper projects which aren't getting the investment because it has that reputational impact potential in the future.
I think it's also that there's something a bit unique about the Australian market in terms of the makeup of ACCUs, and the majority are land-based, and so there's clearly then the link back to benefits to communities, to Indigenous organisations, etc. So it's a bit of a unique market in that respect. But maybe Peter or Fred, do you have any thoughts in terms of what do investors need? What are they seeing? What makes you able to invest? And what would you like to see?
I can take a stab at it at a global level. At a global level, for many of our investments, I think there are probably a few trends that we are seeing or a few things that we're looking at right now. First, I think that there is actually a shift from values to value. What that basically means is that in the past, when we started our work, maybe in the early 2000s, there is a sense that the momentum is strong on climate action, and you can almost invest on faith, right? That something is going to work out. You invest in a nature-based project somewhere, it's generating credits, somebody's going to buy it when the credits are being generated. Today, there's going to be a lot more checks around whether there is actual offtake demand, whether there is going to be a high level or low level of methodological risk associated with those projects, and also a greater scrutiny around project ratings and things like that, right? So you want to go from values to value. The second thing I think that is also important is that we would be investing into jurisdictions where there is a greater level of policy coherence and certainty. Now, even if you think about the ACU market, for example, right? So overnight, if there is a decision to extend the life or the shelf life of particular ACU projects, then it basically means, or project types, it basically means that some of the newer project types that might be more costly, potentially higher quality to execute, but those things are going to have a slight depression, at least in terms of your forward curves around the pricing, because you're going to have cheaper existing credit types that are going to be lasting for longer, right? So then, do you actually believe that the premium can be actually preserved for as long, right? Or there's going to be much faster premium compression? If so, then the returns are going to get affected, and that is going to impact how an investor is going to think about the likelihood or the attractiveness of an investment, for example, right? So the third thing that I think is very important is that today, it is no longer possible to just underwrite nature projects purely on carbon market terms. It is probably useful to consider whether there are alternative value streams to that nature activity. For example, if it is going to be pure conservation and all you're getting out of this is actually revenues from carbon credits, then you are subject to the volatility of the carbon markets. Whereas if this is actually a project that is seeking to maybe introduce some aspects of sustainable forestry, commercial agriculture, alongside maybe soil regeneration and other things that could have carbon credits, then you're not singularly exposed to the volatility of the carbon markets. Would that make better commercial sense in this current climate? So these are some of the things that we are kind of like grappling with right now.
And maybe I'll just add to that. I agree with you that the blended landscape investment strategy is what makes sense, because you are de-risking that price volatility. And all of our investments at CEFC has that strategy. It's mostly traditional commodities, mostly the logs at the back end of a long-dated forestry project. But what the carbon markets does, it helps in the earlier years of these projects where there are no, to de-risk some of these projects' cash flows up front. The one thing I would say around price compression is, what's interesting is there's a slow narrative, and I don't know if you're hearing it, Peter, in the Australian market around tranching vintages of credits. So to your point around, does that premium go forever? Probably not in the future. But I would say that pricing of credits, like most things, is mostly driven, other than the policy framework, is driven by supply and demand. And these nature-based credits, as Sasha and Peter, we all know that you can't turn the switch on and off.
Yes.
Right? They take 3 to 7 years to generate decent volume of credits. And so when you need them, they won't be there unless you're going to take the risk and invest today on an outlook of 5 years, 10 years' time, when they will be needed. So what we're doing is we're trying to support the delivery of high-integrity credits with an investment strategy of blending agriculture production, forestry, new forestry plantations, to get those things off the ground, which de-risks the terminal value of those assets, but the carbon markets really help to accelerate new development opportunities.
Yeah. In some of the other markets that we are operating in, I think what you can actually see is a little bit of an intervention, and it depends on the organizations that would do that, about certain kinds of like contract for difference, price guarantees around a certain level of price expectation. Because you would, the reason why it is going to be difficult is exactly as you say, there will be always some volatility around demand and supply, right? Now, if the prices are going to be swinging quite significantly, it makes it very difficult for investors to commit. And so one of the ways in which we could potentially do that is to think about whether there are some pricing mechanisms that can allow that volatility to be somewhat either hedged or controlled, so that you don't actually fall through the floor or at least go up the ceiling, so that you can cap off some returns, but you actually just have a certain assurance that some basic floor price is going to be maintained. Because ultimately, there could be very good policy reasons to extending the shelf life of particular projects. And that would therefore mean that there's going to be pricing pressure on some of the newer projects that you're coming in, but you're trying to attract investments into those projects that are preparing you for the future.
Exactly, which is why the last transaction we announced was that Rio Tinto helped reduce some of that pricing volatility with a very long-dated forward offtake.
Yes, that's exactly
And so,
right.
but not for the entire portfolio, because you want to retain some upside and protect volume risk, right? Manage volume risk. But that helped that investment strategy.
Yeah.
Maybe let's bring Peter in. What are your thoughts, Peter?
My thoughts are it's great conversation that I feel like I just could sit there and listen to this. It's you can geek out on a lot of stuff at COP. You can go anywhere and go really deep. But to have this conversation with you two, it's awesome. Three. I think there's so much complexity and opaqueness in carbon markets, but we're continually getting new entrants in all the time, but particularly at the investor side. So it's an attractive area to want to get into, but it's not easy to understand the complexity of it. Some of the questions, even just asking each other here, and having deep knowledge of this, reflect that. So one of the things that I think that provides a pathway to getting investment is the history of what has happened in the markets. And because some of the things that you just touched on, Fred, is building in better risk management tools, building in ways to manage volatility, that's the sort of stuff that's going to allow investors to come into this market without having to take all the risks. But in the history that we've had with the CDM, with the voluntary market and concerns over integrity issues, if this is day one, the challenge for project developers, for market participants to attract investment is to be able to communicate that the risks are being managed, that the risks around in participation in carbon markets, because the investors are new funds, they're high net worth individuals, they're countries, they're state jurisdictions. There's all different participants who want to come and get an understanding of the carbon market, but particularly around risks. And so some of the things that you've been developing and implementing and managing and evidencing are the sort of things that we need to actually highlight if we want to bring participants in, which include the corporate balance sheet. Because one of the biggest investors that we're going to have, not just in carbon markets, but in climate solutions globally, is one of the things that I think we should all be really excited and encouraged about in the wonderful world of climate change is that the corporate balance sheet is going to continually be unlocked, looking at deeper into scope 3 emissions, looking at their value chain, their license to operate. And that's something that actually is going to involve investing in and co-investing in projects.
So I've thrown my questions out, but I do really want to make sure that this is interactive. So now is the time, if you have questions on anything related to climate and nature finance and how do we drive more capital to where it's needed, now would be the time.
Thanks, Sasha. Hi, my name is Anil from Carbon and Clean Energy Solutions Australia. We provide carbon market services to our client. I just wanted to resolve this debate between two of you. Frederick, you asked question, why would a compliant buyer would opt for a high social co-benefit credits in compliance market? So our experience working with our client is that in Australia, first of all, Australia is a very small carbon market if you compare it with the other global carbon markets.
Sure.
And usually people know who's buying what as well in the market. They know each other. And secondly, the buyers who are compliant buyers, they do have their internal integrity framework. They have got their own policy. And what we have seen increasingly is that they all want to buy credits, not just a compliant credit, but credit that brings social core benefits. And that's purely because of the reputational risk. I just wanted to
I appreciate
Thank
that,
you.
but I think the point I'm making is not that the corporates don't care. In fact, if anything at all, in my visits to Australia, talking to some of the largest buyers, right, your Rio Tintos, BHP Billotins, Qantas, I find the teams that are responsible for this thing extremely thoughtful and actually very well-meaning. So I'm actually very impressed by many of these teams. Now, the point that I'm making is that in the compliance market, you don't tend to sustain a big spread on pricing or the range of quality because it would tend to generally converge. Now, I'm not saying that it will necessarily converge right to the bottom, but it will converge. And therefore, if you are right at the top of this spectrum, you're going to see price compression. Just like if you're right at the bottom of this spectrum, you're going to see a lot of pressure to up your game because people are just not going to accept that quality or the way that you have designed a project, right? Yeah. But it comes down to a simple thing. Like, for example, in Corsia, it would be very interesting to see how it actually plays out once we go into the mandatory phase. But you can almost certainly expect that for that particular industry where margins are extremely thin, that the airlines are going to ask themselves very, very carefully, why should I not be buying the cheapest possible CORSIA eligible credit that's available out there in the market that passes some basic standards on socio-economic impact, co-benefits, da-da. But if somebody is going to sign off and say this is good enough for CORSIA, why would it not be good enough for me?
It's true about the airlines that, like we speak to the airlines in Australia, and so we know what their appetite is, but they're not the only buyers of credits. And the other perspective on that, and I don't disagree about the convergence. I don't disagree with you, but it's about where it converges.
Yes, of course.
Right? It's about, does it converge at $100? Does it converge at $50? I don't think it's going to converge at $30, $35 personally. That's just my personal view, not the views of CFC. But I think the other element to this is the cost of production, right? So technology innovation to drive the cost of these solutions is going to make it better to sell into this market where you're delivering reasonable cost carbon credits to buyers of compliance, right?
Yes, of course.
So if you're looking at how do we innovate, scale up to create a solution where the cost of producing this isn't, well, it's more attractive in the going forward, and then the price, because of the demand and the supply side not being easily turned on and off, I think if you just think about those things, we are going to, the $35 ACCU price at the moment has been stable for quite a long time. So I see it only as the baseline for where we're going to start. Yeah.
The only caveat I'd put on that and what you said, Fred, around Corsia is that it assumes there will be supply that will come on. If there is a supply crunch of some magnitude, then it's actually then a competitive position to secure supply at the price which makes it a seller's market. If there is a competition between, if you take Australia, Qantas and Virgin, and neither of them have hedged their liability, then a supply is offered at a price way above the market traded price. The question then is, are we going to secure our risk? Are we going to secure our supply and take that price?
That's a fair
move
point.
the price up?
Okay, guys, sorry. We're going to do a speed response round, okay? I have at least three
We're geeking
questions
out
here,
now. Stop
and we don't
geeking
have
out.
a lot of time. So we're going to have quick questions and quick answers, okay?
Sure.
Hi there, Mark Tilley from Carbon Pulse. I just was curious, Hee Chung, on your perspective on the current spot price of ACCUs, given that it's currently the cost of producing those through the main methodology right now, which is environmental plantings. The cost of producing those ACCUs is far higher than the cost that you get for selling them, at least, on the generic price at the moment, sort of thing. So I'm just curious when you think that will actually, when that was going to shift upwards, I suppose.
Well, maybe I can share with you some numbers that we've been using to make our investment case. The $35 is the generic ACCU price, but there is a difference between the generic ACCU price and environmental planting ACCUs at the moment, and it's about $20 a tonne on average. You'll also see a price spread between generics and First Nations-led projects like Savannah Burning. Some of those are being sold at $100+ per unit because they're not easy to obtain. The high integrity, when we say high integrity, we're talking about not the integrity of the system, but actually the more broader social and environment impact projects are demanding a premium at the moment. So all of our projects that we have invested in with private capital, mostly, is based on a premium because of the nature of the cost of those projects, which you are correct on. But EP is next on the cost curve, right? It was HIR then EP. And if you look at CSIRO's cost curve, EP is where the baseline of cost is going to be for these ACCUs going forward.
Okay, can burning responses really quick? Fred?
If we extend things like Savannah, landfill gas, da, do you not see that the forward curve on EP would be compressed?
It depends on your outlook on where the facilities will go in terms of their decarbonisation.
Okay, next question.
Yes, hi. I'm not a finance specialist. I'm an agriculture specialist, and I'm trying to develop methane emission reductions in rice production, finance getting carbon credits, and coming back to farmers so they can actually scale up. So actually the potential would be really, really high. And we have really good technical experts and expertises there. Now there's this gap, you know, for an investor to come in to say, yes, we invest for 10 years. There's this gap, and we work in any countries. I mean, there's 108 countries where rice is produced, but each country will be different, no? So there's this gap of actually get going. And we really, really struggle because we are ready technically, and investors, the due diligence of like, and even giving like or some kind of upfront grants or something to say, show me your model, prove me that in this country we can go forward, and then, you know, so there's this gap that we are just like in the middle of it, of not being able to actually get to work. And I don't know what you.
We have done investments into sustainable rice farming in India and in Southeast Asia. So investors have been prepared to step up. And I think that you're also likely starting to see quite significant institutional offtake of some of the credits that are generated in this. So
Maybe for
after
the
this.
smaller scale landowners. So we recently launched 2 programs through National Australia Bank and Rabo, which was to provide concessional financing for specific projects. So for Rabo, we invested $200 million for farmers to access cheap financing to implement EP projects on part of their land. And with that was an EP guide. So there's a whole bunch of capability considerations in undertaking these projects, because as you heard, Peter talked about geeking out. It's complicated. So we're trying to build instruction manuals or a how-to-do guide with the cheap financing, and we did that through Rabo, and we've done a very similar program through the National Australia Bank for low carbon farming. So not just about carbon credits, about abatement. So that's one way we can think about deploying this at a bigger scale.
And just to add on that, I mean, for example, one of the if you're a farmer and you want to apply for this concessional finance, you could be planting legumes in rotation, and that qualifies. So it's a much broader concept. I think we're over time, but I am very thankful for everybody to stay here in a very engaged discussion. We have one more question.
Okay, yeah, I am nervous about getting another technical coming up to 5 p.m. on a Saturday, but we really appreciate this. It's actually, for those of us in this space, we enjoy these highly technical discussions. On the topic of the generic price spread, maybe if I can come at it with a different question, which is a policy question. My question, and then I'll come back to the premise, but is effectively, how helpful or unhelpful is it that we have a lack of clarity as to when new methods are going to be released, what methods they're going to be, and in what time frame? Because I think the reality is, of course, if you need to buy at scale ACCUs, then of course you need, you know, as close to the cheapest price you can get. Today we do have legacy HIR credits in the system, and I think Heach is right that most forward-looking buyers, not only from an integrity perspective, but a supply security perspective, are looking at the live method of EP, they're looking at the supply crunch of 2030, and they're willing to pay a premium. But to your point, what is the new Savannah method? How cheap is it to produce per tonne, etc.? So I think developers and investors are going to have to take a multi-method view. In light of that, my question is, how can we encourage our policymakers to either speed up or increase transparency on this method creation and delivery process, whilst at the same time being as careful and thorough and thoughtful as they are to release methods that are of the highest scrutiny, integrity, and getting that balance right?
Oh, maybe I'll start, because we had this discussion when we knew HIR was, for those of you who don't know the Australian market, the human-induced regenerative method was coming to its sunset. All of our methods have a natural 10-year sunset. It's a policy requirement. But at that point, there was so much scrutiny in relation to a couple of projects, actually, that then undermined the whole system, which was very unfortunate. So to your question, Paul, incredibly unhelpful when policy can't respond to these distractions, I would call it. Because we underwent an entire carbon market review with Professor Chubb, which was actually quite a useful process. And don't forget, all of these regulatory processes should undergo a review from time to time. But the fact that that method has disappeared or sunsetted and no new method has replaced it has been problematic. And so what's happened is, and we've got investments with HIR, to be clear, we're exposed, but people are still buying it quietly because they're the only ACCUs that are in the market at the moment in volumes that you can buy. So they're still being purchased. People are looking at the fundamental aspects of those projects, and so there is DD going on, but they're still being purchased at the price that we're seeing. But it is unhelpful when new methods take a long time to develop. But because of the Chubb review and because we've gone into a proponent-led method process, it's incredibly hard because what I'm hearing is that the regulator has, numerous submissions by all sorts of proponents to support their method. And just filtering that through a governance process is incredibly time-consuming and difficult. So maybe the pendulum will swing a little bit the other way, Paul, where we can speed up, the production of new methods. But that is a really good point and incredibly has been unhelpful, actually.
I'm just going to say one thing really controversially in relation to that. We've had 3 different iterations of when we've had methods developed and implemented in Australia. It's entirely up to the Minister of the day as to the priority to drive that. So when you had a Penny Wong and we had Carbon Farming Initiative under the carbon pricing mechanism, when you had Greg Hunt, we had to get the emissions reduction fund up. The Minister of the day took the responsibility, said, we're driving this methodology development. I'm going to approve it. We want to get the ERAC, the Emission Reduction Assurance Committee, the Clean Energy Regulator, the department all on side. So I think the key to unlock some of this is the Minister of the day going, I want new methods, let's get them, put the legislative process in place, employ more lawyers, and let's make this happen. That's my view.
Wouldn't it make sense to actually decouple some of the decision making on these things from political election cycles? Because investment decision making horizons are not tied to election cycles. And this is going to be a real impediment, I think.
Completely agree. I mean, I think that there's an immediate need, and then there's the need for long-term planning and long-term frameworks and standard meta frameworks that guide development over time, right? I think we're at time, everyone. If you could all join me in thanking the panelists for a very exciting, dynamic discussion. And I'm sure that they'll stick around because I think that they're going to want a lot more discussion with themselves, but I'm sure that they'll want a lot of discussion with you. So if you have any questions or thoughts or want to debate something, please stick around. Thank you.
Thanks, Sasha.